the last topics, what I'm going to show you, advanced topics, is about over-optimization, curve fitting, and in-sample versus out-of-sample. Because the biggest problem in backtesting is curve fitting. And also a problem is there is no red flag. You can't see if you have done curve fitting or not. So most of my students, most of my clients, they are very enthusiastic. If they start backtesting, they would like to find the best set of rules. They are doing, I don't know how many workflows in optimization, and to put in, I don't know, one more indicator, an additional indicator, and it's getting too much. And what they are doing sometimes is curve fitting. They don't know that they are doing curve fitting, but they do. And the problem is that normally you can see. But to avoid this problem is that you doing backtesting on a so-called in-sample time frame. And if the system, let's say it in simple words, if the system is ready for trading, and before you start live trading, you're doing an out-of-sample backtesting. Out-of-sample and in-sample are very important terms in backtesting, and it means that you pick up some dates, some years, and you put them aside, and you don't pay any attention to the out-of-sample dates unless your system is fully developed. But there is still, if you're doing this, there is still a problem. You optimize even if you don't optimize. Let's explain what I mean in practice. Okay, so back in Wealth Lab. What I'm doing now is I open a saved optimization. I hope that this works. Yep. Okay, so we have here a fully developed trading system. You can see here the backtesting, the date range from 2000 to, in fact, till yesterday. Let's do that. We have here position sizing 20%. Let's do here a backtest. Okay. So, is this real? 50%? I don't know. But let's stick to the facts. 50% annualized percentage return. This is a simple end of day trading system. But is this now real or is it fake? Yeah, let's go here to the date range. What we have done before, the target market analysis and all the analysis with transaction weight and so on. Strictly speaking, we are doing it false. That's not correct doing this way we have done before, because we are using the last, I think, 20 years we put in. But that's not in-sample and out-of-sample. What you have to do for in-sample and out-of-sample is that you say, for example, most recent let's say year range, and let's say, I don't know, 2007 to 2020. So this is your in-sample date range. Should be 14 years or something, 14 or 15 years. And you put aside the years 2021 till today. And you don't look at the years 2021, 22, 23. You are developing your system with this year range. For example, of course, you can choose other years here, other starting year, but it's important to put some data aside and you don't look at this data. So if you do it this way, it's of course better because it's not really difficult with the technical possibilities you have today with WealthLab and with some other backtesting tools, that you will find a set of rules that works in the past. But it's very difficult to find a set of rules that will work in the future. And of course, nobody knows what will happen tomorrow, next week, or in the next year. Nobody knows. No one has the crystal ball. So you have to be careful if you develop your system. And so you have to stick to an in-sample time frame. And if the system is fully developed, then you can look in the missing years, in the years 2021 and 22 and 23. But that's good. But if you do this, you get a feedback. What will happen in practice? You're doing here your system. You say, okay, the system works very well. And the next step is to look in the out of sample date range. And then you look at the out of sample date range, and let's say the system does not work good in the out of sample time frame. Then you go back in the in sample time frame. But at this time, you know the out of sample data. And this knowledge you put in your in sample time frame. And that's the reason why I said before, you are optimizing also if you don't optimize. Because optimizing, I don't mean that you start the included optimizing tool in WealthLab. I mean only you watch the results from the out of sample time frame. And this knowledge will influence you in your in sample time frame. And this is very problematic, in fact. And to avoid this, it would be better to go back to the, this is a solution for advanced traders. This trading, if you are backtesting beginner, maybe you don't even know in sample and out of sample, but if you know in sample and out of sample time frame, it's very good to use these two time frames. It's better than doing no out of sample backtesting. But a more advanced solution is to go back and to make the selection, as I told you before, let's say most recent N years, let's say 25, I have no idea. And WealthLab splits in the background in an in-sample and out-of-sample time frame. And that split you can think here. You can put in here. You can say, I'm doing all my optimizations over the last, let's say, 25 years, but WealthLab should calculate an in-sample and an out-of-sample percentage, like here, 30%, 40% out of sample from the given time frame you choose before. Okay. Okay, so, and when we will do this, let's go here. Yeah. This is a saved optimization. This is a trading system that consists of many different indicators and parameters. And what we have done here right now is a optimization of all these parameters. Of course, if you are optimizing all of these settings here, it takes a long time that the computer can go through all these settings, because you can see the increment is here 1. So that means this step is 70, 71, 72, and so on, to find the best results of all these settings here. So there are many different optimization methods in WealthLab. There are so-called intelligent optimization methods and non-intelligent. If you're doing exhaustive, that means you're doing all of the things here. But you can see here the permutations. I think the computer does not work with this. It's 1 billion, I think here. So it is not really practical. So what you have to do is to choose an intelligent optimization method here, the so-called SMAC optimization. It's too difficult now to explain how this works, but it's a very good optimizer. And with this optimization, you can doing optimization like this, I think 10 minutes. But I have done this right now, and now it's about curve fitting. So the question is, can we really expect 50% return, or have we made here over optimization, curve fitting? So we have here the possibility to go to the parameters and metrics tab. And what we can do here now, let's focus on this graph here. We can compare the two metrics, our performance in sample and the performance out of sample, APR out of sample. And we have to share the axis, the X and the epsilon axis. And what we can see here now, the blue line is our in-sample performance. And you can see the optimizer is an intelligent optimizer. It starts here negative, and as long as it's running, and it's running, and it's running, and it's trying different combinations, it's getting better and better. And in fact, it stops here at a performance of 52%. But I don't think that we really would make this high profit with this simple strategy. I think that's not realistic, because it's over optimization. And that it is in fact over optimization, curve fitting, that you can see on the red curve. It looks like a seismograph here, but what is important here is that you look how long is the red curve able to follow the blue curve, and is the red curve also ascending, because it's not difficult that the blue curve is ascending, because this is in sample data. These are known data. The red ones are unknown data. And so it's the question, does the red curve follow the blue one? And how long does the red one follow the blue one? And till what point? And I would say here, in this region here, this is the maximum that is realistic. And as you can see here, the red curve does not go up anymore, goes sideways, and it can't follow the blue curve. So this, from here to the right-hand side, everything is over optimized, over-optimization. This is not real, what you can see here. So what you have to do now to avoid this over-optimization, because if you are a rookie trader, and you not a rookie trader, let's say a rookie backtester, you have here your results and you are happy. You think you will make 50% a year. That's not realistic. But most of the people have no idea about these tools here. So they don't know what this means. And this means here is the red flag. Yeah. And this is not realistic anymore. So what you have to do is now to go through your trading system parameter by parameter and to make new settings so that you that the red curve will follow the blue curve the most way here. Your goal should be that you have two curves, they are nearly running side to side. You won't be able to do this till here, but it's good if you will reach this region here. And this, of course, that would not result with 35% per year. So this axis will be different here if you do this new parameter settings. But the results you get, of course, they are less, but they are realistic because this is not realistic.